Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook and your host for about the next 20 minutes here on Options Guide TV. Today is going to be about Micron. MU is the symbol. It's been all over the place as we head into earnings. It started up pre-market. It was down fairly decent amount yesterday, and now it's flat. This Micron Technology is trading at 1,000. We'll call it 1,050. Let's just round off to that nice number. Now we're going to look at doing a skip strike butterfly. Now we talked about this on Monday. We said we would do an open wing on Monday because we had a little bit more time premium and then we could get it done, extremely cheap. We got an expensive underlying stock. We got high implied volatility, and implied volatilities have actually gone higher, which has a tendency to happen. So let's run to the Trader Pro software, and we're going to look at the setup for the skip strike butterfly. And we have earnings tonight after the close, June 26th expiration we're looking at. So 2 days away, going to the Friday expiration. Now, ideally, we would like them to announce on a Thursday or have a daily option contract, if you will. Not a big fan of dailies because it does take away some of the liquidity of the more heavily traded options. I kind of just like if we would stay in the weeklies world, but in this one instance, I would rather have, if I'm doing a skip strike butterfly, I would rather have 1 day of 1 day to expiration, because there's going to be so much time premium in these option contracts just because of the cost of the underlying, let alone the fact that you have that it's trading at 180% implied volatility on the at-the-money option contracts. So that also means that if we look at by Friday, what is the expected move with the stock at 1,150, 1,050, we're looking at about a, let's round them off to 60, 120 point move. So at 160, so that puts us at 180, right about here. And that's usually about a 20 delta. So there's two different ways that you can get to the expected move. You can look at where the 20 delta is at and realize that even though we're doing this to the bull side of things, because we've been mainly bullish. Why? Because the markets have been. But at the 1,180 strike, that's usually about the 20 delta, and that's usually about where the expected move comes in at. So all we're doing is buying the most at the money straddle, looking at paying the ask for the call, paying the ask for the put, adding them together. That's 120. That's the over under in my if you're using gambling terms, I guess, as to what the marketplace thinks may happen before that Friday expiration. Now, this is important to note that this isn't after earnings. A lot of times it turns out that it does move very close to what the marketplace is expecting, but this is actually till the Friday expiration. So you have an extra day of time premium that's in here. And it's a little less than 120 because we're trading at a little bit lower than $60 an option contract. But we don't need to be exact on it. We just want to make sure that we're out beyond the expected move, and we're going at least to one standard deviation move, which is excellent inside the Trader Pro software. They highlight the one standard deviation move, and they say anything that is in the gray above and beyond is beyond a one standard deviation move. So you're going to, wherever this is at, it should be close to 16. The market's moving right now, but it should be close to a 16 delta. That's about where a one standard deviation move is at. And once again, these are all just about, and this, estimates as to what these things could be based off of the numbers inside the chains. Okay, so now I'm going to center it around that one standard deviation move. And we are hoping that we don't have a two standard deviation move, which is a very low likelihood of happening. But earnings is a catalyst that is a big catalyst that's unknown. So in Micron, the last 4 out of their last 6 earnings, the stock has gone down after earnings. The biggest thing about that is, and then I'm going to run to the chart right now before we get ready to set up the skip strike butterfly. And the biggest thing about it is, though, is the parabolic move. So big move up, announce earnings, big move up, announce earnings. So they're selling off on earnings. We had to move up, but now we've came back and started to trade within a range, bumping up against the 20-day moving average, still way overextended relative. We can add some days here too. Let's go 1500 relative to the 200-day moving average. So we're still in an area, that's concerning. Being that far overextended. The 200-day moving average right here is at 410. We're all the way up to 1,000. So 600 plus points away from the 200-day moving average. A lot of things usually will have a tendency to drift back towards that number. But in this instance, we're going to do something that is bearish overall. The skip strike butterfly, in my mind, is an alternative to a short call spread. You're selling that call spread to help pay for the butterfly. So the butterfly is a hedge in this instance. And I don't mind this trade at all around an earnings event like this. You do worry about the fact that companies can gap open and not allow you to have time to trade out. But for it to gap open 2 standard deviations, it's possible, even though the math kind of implies that it's not. It is possible because we're talking about the real world as opposed to the theoretical world. And but it's always an interesting trade to me because you have potential for strong upside if it does the normal, does the expected move, and if it goes down, you still are profitable. And that's the way that I like to approach this type of trading. So 1,190. 1,200. So this is 10 points wide. We're looking at a $1.25 net credit to the account. And I like that number. I'd like to be somewhere around $1 at least. If you're looking at just selling the short spread, normally it's going to be about double that. It would be about $2 or so. But $1, let's grab I'll put it in at 110 when we send the order. And let's send this over to the what if calculator and we'll talk about it, and then we'll come back and we'll send it down to the trading floor. So send to the what if calculator. Okay, so here is the profit and loss graph. The stock is at 1,042. It's moving down. It's actually gone down since we put the trade on. So 1,042. Or since we started the show, I should say, very rare. It usually goes the wrong direction. But in this instance, 1,042 is where the market is at. As we go up, 1,200 is where our precipice is in our skip strike butterfly. Some people call it a modified. I like skip strike because you're literally skipping a strike to embed the credit spread that pays for the butterfly. So I like that terminology more, and that's what I call it inside the options playbook. Bring in a net credit of about $1 on the way down. As a matter of fact, it grabbed exactly $1, and you can see that because it says 100 here and 100 over there. That means that if you got it done for a net credit of $1, if the market opens down, you can make that $1. And you're going to make that quickly if the market opens down. Now, if the market opens up, we need implied volatility to come in, which usually happens, and we need time decay to happen. So if it gaps open and it goes all the way up to the 1 standard deviation move, up to $1,200, then at that instance, we'll probably be down on the trade. As a matter of fact, we will be down on the trade. Implied volatility will help us out, but this is where the profit and loss graph is as of right now with the pumped up implied volatility without the earnings report. Now, if I click this and I just move this 1 day, we're going to take the date. We are on right now the 24th, and let's just go to the 25th. Now watch this line move. It's going to not move a ton because implied volatility is still really high. It's not pulling in the implied volatility, but we click on that. Now it starts to move a little bit. Let's go one more time to Friday. And now all of a sudden we're starting to see this move in towards the sweet spot of the trade. And now if we get a little closer to the expiration, I think I got to do this in Army time. 16 would be there. So let's go 15. now it starts bending up towards the middle. And if we finish right here, we could actually put this on for a net credit of $1 and take it off for a net credit of 10 cents or of $10. So the maximum that it can trade for is $10, which is the width between this strike, the one that we bought, and the one that we sold. Our risk kicks in if we go another $10 and get up to the standard strike that we would have bought if we did the butterfly, which would be the 1,210 strike. And then we go to the 1,220 strike. So this is the trade, hoping to make at least the dollar. But if it does drift this way, we can potentially make more. So our ideal situation is that we land somewhere in the middle here. And time decay happens and we get to Friday and then we start moving towards the strike. If we go all the way up and we blow it out, well, our maximum that we can lose is the $10. The maximum that we could have made, the $10 is also what we could lose, minus the net credit received of $1. So this would be $9 or $900 if the market doubled and went to the upside. So we're risking we're risking 10 points for the potential to make 10 points if we went out right at that expiration. But if you're doing this trade, you're not looking for the home run. You're looking to bring in a steady amount of income. There's a lot of areas anywhere below this number, the lowest strike, 1,190. This trade's profitable. As long as the stock stays within that range, we're profitable on the trade. But we're not looking, if we did the open wing butterfly, you have a chance for higher profits, more risk, but higher reward. And then obviously you could just look at buying the stock outright or just buying a call outright, which is really hard to do around earnings, just because of dealing with implied volatility. You're trading that more than you are trading the actual movement of the underlying stock. All right, so let's go back to the trading screen. We have our order in here. Let's move this up a little bit. And let's give you the quick read back. So we're now at, well, we're going to put it in at $1 is what we're going to send it. And I would work the order at $1. Now it's 105 now. So it's all over the place. We're down 12. Wow. And this is jumping. Okay, so here we are. Micron Technology is announcing earnings after the close today. The stock is at $1,040.79. It's down about $10.50 on the day. We're going to go to the nearest term expiration, which is the June 26th expiration, only 2 days away. We're going to buy the 1,190 strike call. We are going to sell 2 of the 1,200 strike calls. And then if we did a standard butterfly, we'd be buying the 1,210 strike, but we're going to skip that. And we're going to buy the 1,220 strike. By doing that, by skipping that, we can get this done for a net credit of, well, the midpoint right now is $1.25. We're going to put it in at $1. That means for every 1 by 2 by 1 skip strike butterfly, we're going to bring in a net credit of $1 to the account. And let's send that to the trading floor. Boom goes the dynamite. Order has been sent. All right, so now in Micron, we did fill our other trade. And I want to kind of show you a different way to enter that trade. And the way that we would enter the open strike butterfly, or open wing, is when we came in, here's the trade that we put on. We bought the 1,250, sold the 1,300, and bought the 1,325 strikes. So 1,250, 1,300, 1,325. So let's, and we're in the same expiration here. So let's look at that trade. That's cleared out. Okay, here we go. Hmm. I'm not seeing the regular strike. 1300. June 26th expiration. Why am I not seeing the strikes? I was going to make a potential adjustment on the trade. Oh, I got to click all. All right, there we go. Very rarely ran into that. I didn't even know I had that as a setting. So 1,250, 1,300, and then 1,325. Okay, so then we sold 2 of the 1,300s, and then we bought the 1,325. Now we're talking the delta at this point in time is up to 6 for this to happen. This is trading for $4. It's trading for $8. We put the entire trade on for $9.30, $930 per butterfly. One of the things, if you wanted to do this trade, you said, okay, the trade didn't work out, the market has gone down, and we're heading into this earnings report, and we still got pumped up implied volatility, it adds risk to your trade. So you've always got to be careful with that. But if you want to try to capture half of the premium that you put in, you can go out and you sell this option and buy one of these. So in this instance, we're going to be selling the most expensive option contract, which is the 1,250 strike. So this would become a sell, and I'm going to click to open because we don't currently have that position. And then we're going to buy to close, and we'll buy to open here. This option contract, I'm going to buy one of those. And then you get rid of this, and you bring in a net credit of $3.25. Now, I don't think I would do this on the trade, but this is an alternative. You could have done it yesterday when the market was tanking and captured enough to actually make this, I don't want the cheese anymore, just let me out of the trap scenario. But this is an alternative because you're closing one of the short options and you're selling one of the most expensive option contracts. So that leaves you with one short call spread from 1,300 to 1,325, done for a net credit of $3. Now, if I could get a real net credit on this, let's say $7 or $8, I would have been interested. And yesterday on the fall, that would have been available. But right now, that would be the hedge. That's the way that I would hedge the trade heading into earnings. But I'm not going to do that because it's not worth the risk. $3 for 25 points of risk, even though we're all the way up at the 8 delta. We're very low probability of it happening. 1,300, we're talking about 260 points in this instance. So if that is the scenario, this would be an interesting alternative to that trade. So writing into earnings in Micron, we're going to make that official paper trade the skip strike butterfly. This trade that we put on Monday, well, the market has moved a lot against it. And you can see that here in the chart. And we'll pull this up and we'll show, here's the drop that we had from yesterday from 1,200 all the way down to 1,060. Still a chance that it could be profitable. You still got a day or two, but you would need that stock to basically blow away the skip strike butterfly that we already placed on and come up somewhere in this range for this trade to be profitable. And that would have to happen after earnings. So in this instance, I would probably just close this trade out because of the pumped up implied volatility. This is the alternative, is to try to pull in that net credit to the account. But in this instance, let's go back to the original trade, add this on, And we have the 1300, and what was our other strike? Our other strike was the 1325. And this is the open wing butterfly. And you bring in $2. So I'd probably just get out of the trade. I don't think the market can move that much. We put it on for 9. You can take it off for 7. You want that pumped up implied volatility. If the pumped up implied volatility goes away, this trade is not going to be profitable. But I would probably capture that. At this point in time, I would take the $2 and I would run. And if I wanted to, I would come back and set up another trade, which would pull this trade down. So we close that one. We finish that position. When then we go in and look at different open wing butterfly, and the market's tanking at this point in time, or we just move on with our trade. But 1060, we would buy this. Go in our instance, we went 50 points, so we bought to let's go 10. Nah, we'll keep it here. 50 points. We'll go to 1,110. Let's hit this twice. And then from there, we went 25 points. So 20 points would be 30. And then we bought this one. 1 by 2 by 1. So now it's trading for $10.52. $10.52. But that would be the concept. If I put the trade on and it didn't work out and the market has came down off this amount, I probably would just cancel the trade, or I'd just sell it, get out and ride it. I like the skip strike butterfly heading into this earnings report. Micron is all over the place right now, more so than it has been over the last 4 or 5 earnings reports. Stock is still a decent valuation. It's kind of the darling of the semiconductor space at this point in time. It still trades at a decent PE even after this huge run up, especially on the forward basis. All right. Any other questions that we have? And hello, Kurt. Thanks for joining. Good morning, folks. Good morning, everyone that's out there. We'll be back on Friday. We'll be doing a fundamental Friday. So we our SpaceX trades that we looked at as hedges. I hope that some people took that recommendation. If you had that position on, SpaceX is still struggling here, and it's kind of making the markets a little struggle. But it's all about CapEx spend. Is there really enough money out there for us to pull off all the AI that all these companies want to do? So Caterpillar's been strong, and they're a benefit of it. It's up another 1.4% today. Been a little bit volatile, but I like to look at companies that are actually benefactors of all of this potential CapEx spend. And that's going to be it for this edition of Options Guy TV. We'll be back on Friday talking about fundamentals. So it'll be Fundamental Friday, and we'll probably go in and look at some companies that are the benefactors of this CapEx spend, and look at some basic option strategies that we can do around these companies. So thanks for tuning in. Hopefully see you Friday, 11 a.m. Eastern Time for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.